much should you be charging for intragroup services during a lockdown? Where can you find good comparables? And how should you best allocate unforeseeable losses during a crisis? These and other transfer pricing issues we'll be highlighting during this episode of IBFD's Tax Takes on the global tax implications of the COVID-19 crisis. I'm Barry Larking, and I'm very pleased to have with me today Rezan Ökten, transfer pricing specialist from Dutch law firm Houthoff. Welcome, Rezan. I'd like to kick off with putting transfer pricing into the context of COVID-19. We know that governments around the world have been introducing tax measures to relieve the economic impact of the crisis. What's transfer pricing got to do with all that?
Thank you, Barry. The relevance of COVID-19 for transfer pricing purposes can be summarized under 3 points. So firstly, the COVID-19 crisis has resulted in major disruption in supply and supply chain of companies, in particular with respect to manufacturing and distribution activities, and this could result in companies fundamentally changing the way they operate. For instance, we could see a decentralization trend. Secondly, the overall demand of consumers has seen a significant decline, and in that respect, the vast majority of companies could be experiencing declining profits and even also losses. Third, the impact of COVID-19 on financial markets has been enormous. We have seen more volatile markets, and also the cost of financing is increasing. All of these points will affect the financial results of companies and therefore also relevant for transfer pricing purposes.
Right, yeah, as we know, profits and losses are key. That's what transfer pricing is all about, where they should be allocated, but also business models, as you say. If there's a change in business models dictated by commercial or economic circumstances, then that could also have an impact. So that's clear. If we take a closer look at what you mentioned, manufacturing and distribution, contract manufacturing and limited risk distribution are key concepts in transfer pricing. How are they likely to be impacted?
Well, limited risk companies such as contract manufacturers and limited risk distributors are expected to earn low but stable profits under normal circumstances using transactional net margin method. However, we are dealing with exceptional circumstances, and multinational groups could return losses. And in that case, we could see 2 issues. One, in the countries where limited risk companies are based, the group will continue paying taxes, and this will increase its tax burden. 2,
right, whereas the global entity is making losses. That's
exactly.
Obviously, yeah.
Exactly. Yeah. And 2, the countries where the high risk, high reward functions are based may not be accepting to take on all losses resulting from COVID-19, especially if they can show third-party evidence that that's not how it is done between unrelated parties.
Okay, so that's the problem, double taxation or losses not being accepted by tax authorities. What's the solution?
Well, there are different solutions. One solution is that you change your transfer pricing model. However, that's only advisable if you can sustain it for the long term. If you're going to keep your transfer pricing model, there are also solutions, but every case can be different and will require its own specific solution. But the key principle is that what the 2 third parties would have done dealing with similar facts and circumstances. And for that, comparability and comparables need to be found.
Right, of course, yes.
Yeah, for comparables, internal and external comparables can be considered. If the company has internal comparables, it's relatively easier to defend your position towards tax authorities.
Right.
However, it's often not the case that the internal comparables are available. And in that case, you need to consult external comparables. But also for external comparables, economic crisis creates issues because external comparables, we rely on historical data. And historical data may not be comparable to comparable issue that we are dealing with in crisis times.
Right, yeah, because last year profits were good and this year obviously profits are not so good. So it's no good comparing this year with last year.
Fortunately, there are also solutions to that problem. We can make certain adjustments or take different approaches. And 3 main ones are, for instance, using gross margins instead of net margins because they are less likely to be affected by the outcome of COVID-19. Second solution could be that using full range of results instead of the interquartile range, as extreme economic conditions may justify extreme benchmarking results. And third, when benchmarking limited risk companies, we tend to exclude loss-making companies. However, in this specific case, you may decide not eliminating loss-making companies to increase comparability.
Right. I mean, that would obviously make sense, because if you excluded loss-making companies this year, then you kind of exclude 90% of the potential comparables. So
indeed,
I can follow that. Is there maybe a fourth solution, and that is to look to the 2008 financial crisis and use comparables from that?
Well, this crisis is somewhat different from the earlier crisis, in the sense that the earlier crisis happened over a slower pace, but and over a longer period of time. However, this one happened in a much shorter period of time. So that could be a difference to consider. Also, different countries may have different views on the use of comparables from financial crisis of 2008. So it's recommended to check the local rules and how local tax authorities would see this issue.
Right.
However,
yeah. So I think that's a general point. Maybe for this whole video, we're talking in sort of general terms here, and obviously, ultimately, one would have to look at how each country sort of applies their specific rules. But
it's also worth mentioning that Chinese tax authorities, after financial crisis of 2008, issued guidance that limited risk companies are not supposed to be making losses.
Oh, okay.
So, you know,
okay, that's a good example. Yeah. Well, I mean, going forward, so if we assume that we've got the comparables, we're still faced with the fact that we have contracts in place. Generally speaking, multinationals have them in place to determine the prices that are charged. Are they a help or a problem in this context?
Well, transfer pricing is generally done on ex-ante basis. However, it is quite common that actual results can be different from the anticipated results. And if such difference is due to unforeseeable developments, there could be ways to justify it. And in that respect, contracts for transfer pricing purposes are used as a starting point, but the facts and circumstances of the case and how third parties would have dealt with each other under those facts and circumstances is leading. For that matter, a two-step approach is recommended. In step one, you need to analyze the contractual framework with focus on any force majeure, modification or termination clauses. And in the second step, you need to analyze the facts and circumstances and what third parties would have done under the same facts and circumstances.
Okay.
And
So there is flexibility in place, notwithstanding what your contracts say. Well, if we move on to headquarters and shared services and the like, do we have similar problems, different problems?
I think taxpayers with respect to services could face three issues. Issue number one is that it may be more challenging for taxpayers to meet the so-called benefit test. As we are experiencing lockdowns and travel restrictions, and some of these services may have not been fully provided. The second issue that the taxpayers could face is in relation to any cost incurred due to COVID-19 because of forming outbreak or crisis teams. And the third issue is in relation to restructuring costs, because economic downturns and financial crises are typically followed by business reorganizations, and those business reorganizations can result in significant cost. Well, the solution to the second and third issue is quite similar. You need to identify the beneficiaries of these services and allocate those costs in line with that.
Right, but what about the situation where you're not actually providing the services that you mentioned? Is there a way out? Is there a solution to that, or are you just stuck with the result?
Well,
no benefit, no charge.
I think if certain services are indeed not being provided, we need to see how third parties deal with that matter, and basically mimic the third party behavior. And if that justifies an adjustment, you need to make an adjustment. However, if third parties under similar circumstances would still continue to charging those costs because the costs are already incurred, then that's what you do.
Right, yeah, because I mean there are situations, I think, as I understand it, if the recipient of the services would otherwise walk away from the contract, then there may be between independent third parties some understanding that there could be a charge, even though there was no actual benefit at that time, to preserve the future relationship. Would
Indeed.
that be?
Yeah, definitely relevant consideration. The perspective of both parties should be considered, and in that respect, options realistically available to them would be helpful in that respect.
Okay, fine. You mentioned earlier on financial transactions, and that's a specific point for concern. The OECD has recently published new guidance on financial arrangements within a multinational. Maybe they should have waited a little bit longer, and they could have also picked up the aspects of the crisis. But looking at the crisis, what are your sort of thoughts on financial arrangements?
Well, I think in terms of financial transactions, there are three topics that could be of relevance. First one is, how do you deal with your existing debt? For intercompany debt, two important aspects could be adjusting payment schedules and also considering refinancing possibilities. And companies will need to reflect the market practice for that purpose. For instance, if refinancing is done, penalty payments may apply. For the new debt, on the other hand, two important aspects to be considered are debt capacity and interest rate determination. During a financial crisis, what we observe is that the number of transactions happening in the market below investment grade is relatively low, and intercompany debt is typically issued at below investment grade. Therefore, companies could have difficulties justifying their debt capacity. For the interest rate determination, what is really important is that the interest rates are currently increasing, so tax authorities may challenge you in the future if you're going for a very long-term contract to be able to incur very high financing costs. So you need to pay attention to the maturity of the loan as well in this respect to reflect the third-party behavior. And last but not least, that we could see more guarantees being issued because companies are experiencing poorer financial results. And for that, the latest OECD guidance should be used to assess what the benefit of the guarantee is to the guaranteed entity.
Okay, great. And what about royalty arrangements? Is that a similar problem, similar solution?
I think it's a very similar problem to the service arrangements. We need to look at what third parties would have done. For instance, would the licensor give a break, royalty break to the licensee, or would licensor take the risk of licensee walking away if that would not happen?
Okay. Again, looking back to contracts, we've seen that there are possible ways out of a contract. Is the same applicable for APAs, because they are, in a sense, a kind of contract?
Indeed, issues with respect to APAs are quite similar to the ones with respect to contracts in general. APAs typically include what we call critical assumptions, and one of the critical assumptions generally refer to uncontrolled and significant changes in economic circumstances. And if that type of critical assumptions included in the APA, taxpayers could start a discussion with tax authorities to be able to adjust their APAs.
Okay, fine. Well, look, Rezan, I think we've come to the end of our short video on this issue. What are your three main takeaways for viewers on this? What should they be doing now?
I think the first thing that the companies should be doing is to conduct an impact assessment to understand how their organization is reacting to COVID-19 from a commercial and operational perspective, which is really important. Secondly, they need to understand what the impact of COVID-19 on their financial result is, and also quantify losses and perhaps also understand what the impact of COVID-19 on their capital structure is. And the second step, what they need to do is to work out their actions and discuss those with the tax authorities. And finally, they should document all of this. And I cannot stress the importance of this enough. This is really important to document.
Right. Well, documentation has always been very important in transfer pricing. So I see that the result of the COVID-19 crisis is that it's become even more important. Once again, thank you very much, Rezan. We've only scratched the surface of this incredibly complex topic. And on that point, it's worth noting that the IBFD will be coming out with a special edition of their transfer pricing journal very shortly. So check out the IBFD's tax takes pages for more information on that, and also on other videos in this series. So once again, Rezan, thanks very much for giving us the benefit of your insights, and thanks to our viewers for tuning in.
Thank you, Barry. It's been a pleasure.